Hello everybody, welcome to the TraderMerlin show for 2021. Sorry for the long delay. I had to take some time off and just go enjoy life, as I hope many of you did over the holiday. And now we are back to brass tacks, starting off our New Year's with not the best trading session out there. We'll look at a broad spectrum of things on today's show, including bonds, equities, currencies, commodities. But yeah, big shout out to everybody. I'll try to run through some of the names. I know some of you probably get annoyed I do it every show, but you know what? I got to give props out to the viewers. Shane, Terry, Greg, Richard, Big Eb, Ivzy, Raj, Homer. Good to have you, Mr. Barr, as well. Richard, Alex, Les, Thomasina. Great to have you guys with us. I know with a hiatus like this, I actually expect a lot of people to just drop off, and I'll check what the numbers are here over the next coming weeks, but I'm sure some people just kind of will fall away from our little following ship. Hopefully we get them back to the program. All right, today is going to be kind of a market outlook show. I don't have any real agenda with the discussion today other than let's get some perspectives on the bigger pictures. Let's look at what might be impacting our markets going forward. We can look at statistics. We can look at the different asset classes and different market segments, but I am probably not well versed to do it all by myself. So today joining me, I'm guessing from the southern state of Texas, we have Mr. Scott McCormick joining us. Scott, how you doing?
Doing well. How are you?
I'm good. I'm glad to just put 2020 to rest. I'm pretty sure that there will be, many of the same problems in 2021, but at least we can kind of lump it all together in 2020 and just kick it to the curb and move forward.
That's what I'm hoping.
Yeah.
It was just one hell of a year, and we were all looking forward to 2020, and then it's like, no, this is not going to be it. Yeah. It
was funny how we get this impression that there's going to be like a hard stop, like just everything will magically end. It's like, no, there'll be some lingering effects from it. But one thing I think that Scott and I can both guarantee you, and we don't usually like to do guarantees, but I can guarantee it, is it's going to be a volatile year. There's a lot of stuff that's still unsettled in the pipeline from political perspectives, from economic perspectives. So, Scott, I thought maybe we could start off with what are some of the major things that you're seeing as being the drivers for the market in 2021, both up and down?
Yeah, so, obviously, we have the political issues that we're still kind of getting through. What is it, the 6th this week? Congress is going to certify the election, and then, of course, we have the inauguration, and so there's still that kind of political uncertainty due to like all of the rhetoric that's taking place. But you kind of get that out of the way. The focus still is on the global economies. What's going to happen with COVID, the variants that we're seeing now, how that is spread, the effect, the efficacy of the
vaccine.
What do you call it? Thank you. The vaccines. So I think that as more of that information comes to light over the course of the next quarter or so, I think we'll probably be able to get additional clarity and maybe be able to take a sigh of relief.
Mm-hmm.
When you look back to, let's say the Spanish flu pandemic, right? They call it the flu of 1918, but what that doesn't really clarify is that pandemic actually went on for about 2 years. So when we kind of stand back and take a look at where we are right now, I think the big factor is going to be how the vaccines are implemented, how quickly they can get it through the population so that we can really kind of try and nip this thing in the bud. And from an economic perspective, get the engines going from, let's say, a 40-50% back up to a 70-80%, maybe even possibly a 90-100%.
Mm-hmm.
But that's obviously going to take time. And so I think patience is probably going to be one of the key themes here, over the course of the next 6 to 12 months. And I know that that's a pretty wide window. But when you're dealing with situations like this, you have to think in those terms. You can't think in terms of weeks or months.
Yeah, and I think that's the kind of the consensus here is this is going to be a longer process. And there was a comment that came through real quick. Let me see. There from Christy says, printing press will go on. Why should we have volatility then? Well, Christy, because there's just uncertainty. You saw Brennan just put in here, it says vaccines have no evidence of working so far. I don't know all of the details of their efficacy or not, but there's these huge question marks, which are, will it be that effective? You know, the initial number I heard was 94% success rate. Interesting, because the flu vaccine, which has been around much longer, is nowhere near that. So it seems kind of odd to me that we'd all of a sudden have this magic bullet just kind of lined up, ready to go. But also, let's just throw a weird hypothesis out there. What if all of a sudden more people are dying from getting the vaccine than actually are dying from COVID? And all of a sudden we have a whole nother can of worms here. Now we're hearing about a new strain coming in from the UK. So now do these current vaccines, are they ineffective? And now we need to get the new and improved version? I mean, there's just all this uncertainty which can disrupt these markets yet again. And even though the Fed is printing, and we pretty much are certain that that's going to continue on forever until something breaks, there still are issues that could shut down the economy and go back to an issue like we had back in February. And it's just uncertain. It's saying nothing to be afraid of or panic about, but just always have those short guns, if you will. I always talk about having long guns and short guns. Have those ready just in case that market opportunity presents itself. So I want to clarify that one because I think that the volatility is going to come in many forms, you know, and Scott does this thing called the Beck Report, which is bonds, equities, commodities, and currencies, and all of those are going to have tremendous moves. We saw Bitcoin rally. If you're not in cryptocurrencies right now, I mean, you're missing the hottest thing in the past few years right now, and that's to say it's current. That could also cool off, and all of a sudden it goes back to the equity market. So who knows? Let's start with the bond market, Scott. We've got, obviously, the Treasury is selling in record amounts, 10-year securities, et cetera, to help fund this debt. Does that kind of still bolster the argument of rising interest rates for 2021?
You know, when you take a look at what's happened in the Treasury market over the course of the last 3 months, it's actually been an extremely quiet market, which is a little disconcerting, you know, because is this kind of the calm before the storm? And do we see treasuries take off? What type of impact is that actually going to have inside of the marketplace? But, you know, and taking a look at the 10-year interest rate, you know, we're about 0.917 right now. So we're still under 1%. I mean, that's extremely low levels. And I think that in order to really kind of trigger any alarms in terms of like the possibility of inflation even kind of creeping back into the markets or into the economy, you know, on a broader scale, you know, we're going to have to see the interest rates not only go up, but go up very quickly. Yeah. And they would have to really kind of get north at this point. I think the alarms would really kind of start going off if we started to see interest rates on the 10-year get north of about 3.25%, 3.5%, which is still historically low level. But compared to where we are today, you know, that's about the highest level that we've seen in interest rates over the course of the last 5 years in the 10-year Treasury. You know, in terms of the 30-year, you know, you're probably talking closer to about 3.5% to 4%. Before we start to see, you know, any real alarms there. But, you know, and taking a look at how the bond market itself has actually been performing, you know, I usually go through and I take a look at where, you know, the government treasuries, government agencies, municipals, corporate high yields, as well as investment grade corporate bonds are performing versus their aggregate index. And, you know, as it stands right now, your 10-year and your 30-year bonds are basically underperforming that aggregate index. But the trend on these things are still up long term, but kind of flat over the course of the last, you know, 6 months or so. And I'm saying about 6 months. I mean, they kind of topped out going back into early August, but you know, there was a bit of a sell-off in mid-August, but really since then, you know, it's just been in a really kind of tight range, slight drift to the downside, but nothing of any real consequence when it comes to the 30-year and the 10-year. And so, you know, in watching these markets, they're extremely quiet. So when I see situations like this, I basically just tack on 2 horizontal lines on the highs and the lows of those range and just set an alert to say, all right, well, let me know what's going on. You know, because from a trading perspective, yes, there's short-term trading that's available there, but you know, from an investment perspective, you know, all is quiet there, and with kind of the uncertainty about what and I shouldn't say uncertainty about what the Fed's going to do, because, you know, at this point, you know, they have a very easy monetary policy, but, right, you know, with the bond markets kind of going sideways the way that they have been, why would you want to take a bet on, you know, what they're going to do? Just let them do it and just kind of hop on as they start to move. That's really kind of my perspective when it comes to situations like this. But when you take a look at, and I think what's kind of interesting for me is I'll keep a close eye on not just investment grade, but also the high yield corporate bonds and see how they're doing. And it's actually outperforming. It's probably one of the best performing bond groups versus the aggregate index over the course of the last, let's say, 3 quarters. And so the reason why that is going to be important to someone like myself is because if let's say that there was a broader or a greater concern or uncertainty about where the equity markets were going to be over the course of the next, let's say, 12 to 36 months, you probably wouldn't see as much money actually going into this area because it is a higher risk, right? Right. So the fact that money is actually going into these higher yield corporate bond funds tells me that institutional money at least is pretty confident about where the markets are actually going to be over the course of the next 12 to 36 months. And I realize that's a fairly wide window, and there's probably a lot of listeners that are a little bit more shorter term in nature. But when you're looking at the markets and you have days like today, where the Dow is down 500 points, and if you're watching a 1 minute chart, you feel like maybe, wow, the market just got its face ripped off, but you stand back and you put that into perspective, a 2% day on the Dow, I think it was down like 700 points at some point. To have a 2% day to the downside, that's nothing.
Nothing.
Talk to me when it's down 5 or 10%.
I mean, it's funny because I have the chart up here right now of the YM futures just to put in perspective, and you look at the moves on this chart, and the move that happened today, I don't know, it gets lost in all these other monstrous candles out there. So yeah, you're right. I mean, having a 2% down day, it's like finally. I'm not even worried about it. It's like, okay, this should be natural to have some kind of correction here given what's happened since, late October. It's just been unbelievable, especially for the Russell. But, these corrections are a normal thing for our markets that need to happen. It's healthy to have a correction.
Yeah. Because one of the things that I like to watch, and again, it's a little bit more from a longer term perspective, and I'll say that it's really kind of beneficial more so from the swing trading perspective to maybe like the intermediate time frame. So imagine for a moment you have someone that holds positions for, let's say, 1.5 to maybe 3 months, right? One of the things that I'll pay attention to really kind of say, all right, well, in the short term to intermediate time frames, like, is that market kind of for lack of better terms overbought, oversold from a sentiment standpoint? And those, basically I'll take a look at the percentage of stocks above their 20-day moving average as well as their 50-day and 200-day moving average on both the S&P and the New York Stock Exchange. And when you look at that, we're well over 70, and so these numbers, they range from 0 to 100 because, we're looking at that universe of stocks and saying, okay, versus this moving average, where are you at? Are you above or below? And if you're above it, then it's going to record that value. Now, right now, we're above 70 across the board on the 20-day for the New York Stock Exchange. We're actually at 90% right now.
Wow.
So
does that concern you? I mean, real quick, because when it's almost like you're overheated. It's like redlining your engine. I feel like I'm in a Castro commercial. Do something before your engine does something to get you heated up, or It's at 90. I mean, that's hot.
That it's very high, and it doesn't necessarily mean that it has to top out here. It can go further, but the idea there is that when you get up to levels like that, then what that really tells you is that there's only about 10% of the market that's left that could possibly push that that reading any higher, right? And so you start to look at it from that perspective. Like, okay, well, 10% of the market could potentially push us a little bit higher, but there's also 90% of the market that is a little overextended, right. And so days like today tend to take the heat off a little bit, to kind of go back to your analogy. But we need to see situations like what we had back in August, September, in even parts of October, where we had those sell-offs, that were, short-term corrections, a couple hundred points on the S&P, you're still in that uptrend, but now it's kind of setting you up for that longer-term trading opportunity, because for instance, like all of those lows in late October, early November around the election, they all coincided with readings, at least for the S&P 500 and the New York Stock Exchange on their 50-day basis. They coincided with these readings at 30%, which said that, all right, you've got 70% of the market now that could potentially push higher.
Right.
And if anybody going back and looking at the charts, they can see how nice of a push that was. But it also coincided with those readings back in the spring, and you can kind of go back and see that from a bottom fishing perspective, if you will, from an oversold perspective, it tends to work a little bit better. But when you start to get these really high readings north of 70 and especially 90, you've got situations where it's like, okay, well, if we do start to see short-term trends in the market kind of break down, that tells us that we've more or less gone from this impulsive phase to a corrective phase. You could be a little bit more bearish if you're a short-term trader, but if you're a long-term trader, it's basically telling you that, just let the market fall, let it go through a retracement, and then look for a pickup, and that retracement might be anywhere between 5 to 10%.
Right. I like how you say look for a buy the pickup. The affectionate term out there would be BTFD, right? Buy the friggin' dip. But
yeah.
Well, what are you using as your metric to read if it's NYSE is over 20-day moving average or not, and what extent?
Yeah. So if you are, I know you use TradeStation, for instance. Yep. So the ticker symbol on these it starts with a dollar sign, and then it's followed by a percentage sign, and then you type in the length of the moving average that you want. So whether it's 20, 50, 200, and then you follow it with DM, as in Delta
Merlin.
Merlin, thank you. Alpha November. Okay, so with that, you should be able to pull that up pretty easily.
So there you go. So I've got it here, and as I'll zoom out here a little bit for the viewers. Let me see. It doesn't look like your normal chart, right, guys? It's going to look it's going to be oscillating back and forth.
It's going to look shoddy. And so whenever I'm playing with these, what I like to do is change that chart to a line chart.
Okay.
And it kind of cleans up that noise a little bit. And then what I like to do is tack on 3 horizontal lines to the chart at 30, 50, and 70%. And, I'll even go through and color code those so that if it's below 30, for instance, I've got a green line, and if it's above 70, it's a red line, and just some visual cues to let me know, hey, you've reached some extremes here, so be careful.
Right.
But you can actually see if you're looking at the 20-day moving average. So you're looking at like the percentage of stocks above their 20-day versus the New York Stock Exchange. And then on a chart below that, I have the chart of the S&P 500. And you can see, it actually topped out, a few weeks ago. Right. On that. So it's even though the market's been going up, it's been going up on fewer issues. So the one that I was looking at before was the 200-day that had that reading of 90.
Wow.
Misspoke earlier, but
and that's difficult because it's harder to get above 90 on a 200 versus a 20.
Considerably harder. It's like and you also have to keep in mind too that when you're looking at this particular indicator, you're not all issues traded on the New York Stock Exchange are individual stocks. Right. You've got special issues that are on there that can kind of skew this information. So you do have to kind of take that in consideration when you're looking at these things. But
it gives you an overall sense. Now with this, this obviously is on the daily time frame. If I was to switch this over to a weekly, does that now, since we're talking about maybe market outlooks, I can go monthly out here, and monthly we're pretty much right in the center. So it's kind of saying, no pressure up or down here. Is it applied the same over those longer time frames for you?
So when you are looking at, for instance, like the 20-day reading on a monthly chart or a weekly chart, I don't put as much emphasis on that. So, if we were to go out and take a look at the monthly chart, for instance, I would be a little bit more concerned about, what's the reading for the 200-day.
Okay.
So if you were to modify that and just the ticker symbol on that and just add a 0,
right,
and then take a look at just convert your chart from a daily or whatever time frame out to a monthly chart, you can see where those kind of really oversold conditions coincide. Unfortunately, there's not a lot of historical information on TradeStation for some reason. On other platforms like stockcharts.com, if you have a subscription to it, you can go back 20 years and actually look at the data and see how well those bottoms actually coincide. But when I'm looking at any reading, and it doesn't matter if it's a breadth indicator like this, or if it's an oscillator of any kind, whether it's CCI or stochastics or an RSI, or if you're looking even at Bollinger Bands, when we see certain types of readings of overbought, oversold, whatever those measures are relative to each of those indicators, the thing that the trader or the person who's applying these tools has to remember is that all those indicators are really telling you is that it's like here we are oversold because X, Y, and Z has happened. So if you're looking at the 200-day moving average, then that's going to tell you that 70% of your stocks are below their 200-day moving average. And if you're in a bear market, it's like, all right, well, thank you, Captain Obvious.
Right.
But what it's also telling you is that you need to start watching for reversal signals on those daily time frames, let's say, to see that, okay, yeah, the market's finally bottoming here. It's time for us to get long, and those 200-day moving average signals, they don't happen that often. It's like if you go back, you see, you had 2011 and then another one in 2015, and then your next one was 2018.
Well, let me real quick, Scott,
just the volatility.
As you read those off, give me the number. It's $ percentage DMA.
No, so it would be the $ percentage, whatever length moving average you want. So 200 in this case.
Yeah.
Does Merlin announce always November? I don't know. I'm just trying.
D-Man. Okay, that's what I thought I had. It's funny because I actually had it in there.
Demon is a little bit more like it, but yeah. So
well, it won't give it. It won't. That's what it just says. It won't give me the 200. So.
Oh, that's no fair. But yeah, I mean, if you were to go out to see if you can do like a 50, and go out to a weekly chart. I mean, I think it's important to, anytime you're looking at indicators, for instance, it's important to kind of relate it to time. So if I'm thinking 200 days, I would be a little bit more concerned about, well, what does that look like versus a monthly chart? Because I know I'm not going to get too many of those readings that are at the extremes, right? And it wouldn't be appropriate for me to say apply it on a regular basis to a daily chart. I mean, you could look at it, but
right.
A 50-day would be a little bit more appropriate for a weekly chart, whereas a 20-day, completely appropriate for a daily chart. And again, the shorter the average, the more signals and activity you're going to see. But you'll notice if the 50-day kind of pulls up, you'll see where a lot of these readings, they take place once the market has kind of reached those extremes to the downside, or vice versa if you're in a bear market. And again, we're just at that point, we just start looking for reversals to take place. If you're an OTA student, if you're using this, start looking for demand. Or if you're a little bit more traditional technical analyst, start looking for candlestick reversal patterns, or Western technical analysis reversal patterns to say, all right, the bottom's in, it's time to get long.
Yeah. All right, so overall it sounds like equity markets, you're feeling, all things remaining equal and no crazy outliers, that it's still just bullish for the equity markets. I think everyone's in agreement that the Fed is going to just keep on pumping it until something breaks or snaps. So looks like bullish on equities. Let's look at currencies for a minute, which I know is a pretty hot topic. Certainly the Brexit deal happening created a ton of volatility as expected in the pound and the euro. The dollar is just, it's on the free fall right now, which we've been talking about for quite some time. I don't see that stopping anytime soon. What's your take on the currency space?
So when looking at the dollar, and I'm looking at the dollar index, ticker $ Delta X-ray Yankee.
Yep.
And again, I like perspective. So when I go out to the monthly chart on this, what I see is that since that high there in late 2016, early 2017. What we've had are relatively equal highs, and so the next kind of relatively equal high was going into the first quarter there of 2020. So when I see that, I've got to think to myself, well, if I have relatively equal highs, I'm probably going to have relatively equal lows. So if I look at that lowest point that's in between, kind of points to those lows that are back in the first quarter of 2018.
Mm-hmm.
So if we have the definition of a sideways trend, then there's the possibility that we actually see the dollar, coming back to this demand zone, if you will, from back in the first quarter of 2018. So there's the possibility that the weakness that we've seen throughout last year actually starts to finally wane a little bit and start to kind of go sideways. So, and this kind of goes back to what I was saying before. It's like if I'm at a support level or a demand zone of any kind, yes, we could try and step in front of that train and be the hero and buy it when it's down at 90 and hopefully a year or two later say, we bought that when it was at 90 and now it's at 110. But on the other hand, if you're looking for that confirmation, that safety, we have to consider that if this is a support level, what should happen? The trends that we see, let's say on the daily chart, which look like a downtrend, should start to reverse.
All right.
So start looking for those higher highs and those higher lows, and say, okay, well, here's my buy point. This is exactly where my risk is. But I think the critical part here is going to be if we do see a monthly close below those lows from 2018, that's going to suggest further weakness for the dollar. And you're more likely going to see it come back down to about that 81 to 78 area, and then if it keeps sliding, then my eyes are going down to about 76 to 72, where it bottomed out back in 2011. Now, because of the way the dollar index is structured, I know you know this. I'm sure many of your listeners do, but for those that aren't familiar, the top three currencies that I always look at are the euro, the Japanese yen, and the British pound in that order. Because the euro, if I'm not mistaken, is like 53 to 57% of the dollar index.
Yeah. Totally overweighted, but okay.
yeah, completely. So, it's like, weakness in the dollar, strength in the euro, vice versa. But then you've got the Japanese yen and, of course, the British pound. But those three make up roughly 81% to 83% of the dollar index, which is why those things are so important to me. So with what's happening in the Brexit realm right now, and, obviously that's going to have a lot of influence on what the euro is doing, but the combination of those two things can actually put a little bit of pressure here on the dollar. And when we do take a look at I don't know if you're looking at the futures or if you're looking at the spot Forex. But,
I'm looking at the spot.
Yeah, so if you're looking at spot and you go out and you take a look at the Euro USD, I've got targets on this that run up to about 128.51 to 136.35. And so, that 136.35 for the euro should actually coincide with the lows that I mentioned a moment ago on the dollar index that are in around like that 86 area, I think it was. Let's see here. Yeah, I'm sorry, not 86, but 81. And then taking a look at the British pound, this has seen a lot of strength here of late. Obviously, a lot of that probably has to do with the with the Brexit situation. There's a little bit of resistance there or supply that could potentially be in the market and around that 137 to 143 area. But one of the things that I like to do, especially when I see charts like this on the pound, I'll take into consideration that even though the pound actually made a low in the first quarter of 2020, second quarter potentially in 2020 at versus the lows from late 2016, it never closed below that area. And so when I start taking a look at the closes, I can see that basically we're just in this big sideways range between about 117.20 to 143.58. Now, what's also kind of compelling here to me in terms of like a bullish argument for the British pound is that if we do break out above that 143.58 area, you have the possibility of running, let's see here, what is that? Sorry, I don't have this measured out for you guys already. But,
no worries. I'm doing it as we speak. So
yeah, so this would actually kind of bring this back up to roughly that 170 area.
Wow.
Which would actually coincide with the resistance that you see back in 2014. So, and a lot of times, when people hear things like that, they'll say, no way that's going to happen. I don't know if it's going to happen or not, but you have to go through and have your if then scenarios, and
right.
if it gets through that 143.58, then who's to say that it couldn't do that? It fell that far. It could certainly go up that far.
If the markets have taught us anything in 2020, it's that absolutely nothing is impossible. So
yeah, expect the unexpected.
Exactly. And this is something that my mentor taught me years ago, Scott, which was the more people believe something is going to happen, the opposite happens. So, now all of a sudden it seems like more and more people are becoming more and more bullish on the market, which is great. Go ahead and be more and more bullish. It's almost a contrarian indicator. And, if nobody in the world thinks it's going to get to 170, God, it's most likely going to get to 170.
Yeah. I mean, it's just one of those things. And I like what you just shared in regard to your mentor, because that was one of the things that I kind of learned early on, is that a lot of the times when people see things that are so obvious, it a lot of times it fails. I hear people all the time. It's like, oh, that's an XYZ pattern, bullish or bearish, it doesn't matter. And it's like, okay, well, if you and everybody else is actually looking at this and you're expecting the market to go in one direction or the other, don't you think the institutions know that and are anticipating your action, are going to use your orders to fill theirs to go in the other direction?
Exactly.
So you always have to, it's not to say that those observations never work. I mean, a lot of times they do, but at the end of the day, you've got to know exactly where your uncle point is and have your stops out there and have the discipline to actually follow all of that stuff and get out if things aren't doing what you want them to,
Yeah, absolutely.
I try to keep things very simple. If I'm bearish and I'm short, I want the market to go down. If it's not going down, I'm analyzing exactly like, okay, why is it not doing what I want it to do? And do I need to get out at a spot earlier than my stop, and vice versa. I don't, it's tough being a guest sometimes on programs like these, because, what a lot of people really want to hear is some sort of explanation as to why something is going to happen. I have absolutely no idea. I'm not an oracle of any kind.
Yeah.
I watch price, and I'll tell you what price is doing. I'll tell you what price is most likely going to continue to do, and if it's not doing it, where it might go.
Right.
And that's how I live my life. It's a lot easier.
It's a lot easier, and I think that I think when a lot of people hear experts come on shows, whether it's here or CNBC, Fox, or Bloomberg, there's like this expectation that person is never wrong. And one of the things that all the OTA graduates in the room know is that it's okay to be wrong, but at least have an idea of where you think something's going to go and have strong justifications, for me, rooted in supply and demand, saying here's why I think it's going to do what it's going to do, and here's my plan for it. And if it does not do what I think it's going to do, I'll have circuit breakers that say I'm wrong, I'll get out, take a small loss. So that way it allows us to take more trades, to go out there and find more opportunities. And if we're wrong, so what? We'll lick our wounds and move on to the next trade, as long as we don't get slaughtered on some big trade.
Yeah. I mean, that's pretty much, at the end of the day, what else are you going to do?
Yeah.
It's like we're market participants. We're here to make money. If the market isn't doing what you want it to, you're not making money. You're potentially losing money. So change that. Fix it. Get out. One of my favorite books, and I'm going through it. I listen to this almost every year. But Market Wizards.
Yeah.
I mean, I have like the paperback. It's oh my God, it's well read. But they also have it on Audible. And a little easier. I can listen / read it, if you will, as I'm driving around town or whatever. And so one of the interviews, my favorite trader is Martin Schwartz. And one of the big messages that he had was divorce your ego from your trading activity. It's like the moment he did that is when he started making money. It's not about being right and proving yourself to other people. It's about being consistent and making money and protecting yourself, because that's another big thing for him. But he's one of my favorites in there.
Nice. Let me ask you a viewer question here, and then we'll kind of wrap it up here. I want to keep your time. I know you're busy. One was from one of the individuals out here. Pepe says, is Scott an OTA instructor? Yes, Scott is the OTA instructor. He does multiple sessions. For XLT, you also do grid and the morning startup, right?
Yeah, so most of my focus here over the course of last year has been kind of behind the scenes. So I haven't really taught too many classes here of late. On purpose actually, because my schedule is just a little too demanding sometimes. And so since I guess August, late July, I have been a regular contributor to what's called their guided pathway sessions for their mastermind students. It's Monday through Friday, and then on Fridays we also invite other XLT students into the sessions. But every morning I go through and I give, it's either a daily, a weekly, or a monthly overview. So today I did a monthly market overview because it's the first Monday of the month. And I went through, took a look at bonds, took a look at how small caps, international stocks are performing versus domestic stocks. I go through all of the sectors. I share the relative strength analysis. We go through supply and demand and trend analysis. The rest of the week, I'll go through and kind of give the perspective, less so from the long term, more so from the short term. So looking at daily and 240-minute charts as opposed to monthly and weekly daily charts to try and just show students like where the trends are, where the supply and demand is inside of the marketplace. Give them some targets for those that don't have supply zones that are out there, and kind of guide them, if you will. And of course, there's also like the other contributors that are in there. But between that and writing the daily market overview, which is kind of a written newsletter kind of thing for OTA mastermind students. I cover 10 markets, 11 markets every day. And, with that, tell them the trends on 2 different time frames, where the supply and demand is on, two zones for each on 15-minute charts. So the trades tend to be a little bit more for that short term to swing trade. You're willing to kind of carry overnight in those situations. But yeah, so that's where a majority of my contributions for OTA has been for about the last 2 years.
Yeah, and working on content, helping us behind the scenes.
Yeah.
One other thing here, and Adam wants to know this too. I think it's Adam and Big Eb been asking about this a few times. Big Eb says, Scott, does this all make precious metals attractive to you then? And I'm going to bring up a few charts here for the viewers that may not have been looking at any of this stuff. But, gold obviously been having a great rally back up. We were talking about that downtrend that was definitely intact. All of a sudden, we saw this great move from 1760 to right now at 1945 or 46. You're also looking at silver. Silver's looking phenomenal to the upside here over the past month. Just curious what your take is on those commodities going forward.
Yeah, so when looking at commodities and so forth, obviously you can go in, you look at the individual names and kind of see where the opportunities are. And, for gold in particular, I've had a target on gold at about 22.85 for 5 years now.
Well, you're going to get there eventually.
No, I know. But, it's like when you take a look at, for instance, the trading activity since August, that was all a retracement back down to a demand zone that was formed in the second quarter of this past year. And so far, we're turning back up, so. I wouldn't be surprised to see that on this next push higher, we actually hit those targets. But one of the things that, I think is important for any of your listeners to understand is that before I even look at any individual security, I consider what asset class is it in, and I compare that to the other asset classes. So one of the first things that I do is I'll look at gold versus the S&P 500. And when you look at it through that lens, it's actually not that shiny, pardon the pun. We started to see some strength there going back into the second quarter of 2020. But even as it was making new highs into August, gold was actually underperforming stocks. So basically, stocks were going up faster. So from an asset class standpoint, if I were to put my money either in precious metals or in stocks, I would put my money into stocks. It's not to say that I wouldn't have some exposure to gold. Personally, I like to scalp gold. It's one of the first markets that are open in the morning for me. It just goes, gold, crude oil, and then equity indexes. But I like to go in there, scalp a couple of points, and then just move on with my life. But
no wonder you're up so damn early.
It's crazy. But when I am watching this ratio, I have key areas that would allow me to say, okay, these longer term trends of relative performance have now shifted. So, for instance, right now, if you were to plot like a relative strength ratio for gold versus the S&P 500, one of the key high that was actually made was 0.62, which was actually a retest of a resistance level going back into 2016. So I know that this is a pretty important area. So if we actually see gold move above that, I would say that the significance is going to be longer term in nature. And so at that point, my perspective would change, because if I see gold outperforming stocks, then that could be inflationary in nature.
Right.
That's going to have implications for bonds. Bonds and stocks have actually had a positive correlation. That might change back to an inverse correlation. So I do watch these things from a longer term perspective, but it's literally been, that relationship switched going into 2012, 2013, and gold's been underperforming equity since. So from a longer term perspective, stocks are still more preferable over precious metals. But here's the other part. If you are going to have that precious metal exposure, you could do that same type of analysis, gold to silver, gold to platinum, platinum to silver, and see, okay, which of these metals has the best relative strength, and then trade it accordingly, because for a while there, silver was actually leading gold, but yesterday or last night's rally, for instance, gold was outperforming silver. So there's the short-term and kind of longer-term relationship. So a lot of it is just put it into context and then trade it accordingly.
All right, nice. All right, I could keep you going on here for hours and hours, but I won't do that for you. So basically, if people want to get in touch with you, you're doing the GPS sessions, which is Monday through Thursday for the Mastermind members, and then Friday is for XLT, correct?
Yeah, so Monday through Friday, it's everybody, right? Mastermind students all week long. Friday, XLT students have special access.
Cool. There we go. All right, so anything else you want to add in here? Any last-minute parting shots?
No, just, I thank you for having me on. I wish you and everybody else here listening a very happy and prosperous new year, and I look forward to being with you again in February. Maybe
Awesome.
We'll have some other things to talk about then.
I'm sure the markets will have something exciting for us. All right, buddy. Well, thank you so much. Appreciate you coming on. Best of luck to you in your trading.
Thank you, you too.
All right, take care. Guys, that was Scott McCormick giving us some insights as well, a little bit of thoughts on the market going forward, a lot about bonds, a lot about equity markets, and a little bit about commodities. So again, if you want to see more from Scott, he does the daily market overview, which is a great kind of summary of what's coming out that day. You also have his GPS session, which I'd encourage you guys to check out. So a lot of stuff from great Scott McCormick. Yes, he does not as a great job presenting his morning, but he's just extremely knowledgeable, and his background and market knowledge are just bar none. I mean, he's just got a tremendous amount. And it's one of those guys that, I always mean this in a very courteous way, he's an absolute geek nerd when it comes to the markets, but so am I. I have my area of expertise. He gets a little bit more into the minutia of things. But if you love this industry like I do, you kind of just geek out on it and just dive way too far into it. So, all right, there were a bunch of questions that came in. I believe, I'll see if I can remember the names. I think it was Lori and Les were asking about buying Bitcoin. I'll show you just to make it as simple as I could possibly make it. So if you go here to Coinbase, all right, Coinbase is probably the easiest way to do it, right? You go to Coinbase, you set up an account, and it just connects to your checking or savings account. Now, I'm going to do this. Now, I hate doing these things because I feel like I'm soliciting. I don't intend to, but if you don't have an account there, you can simply use this, and I believe this will actually give you, I think you get $10. So if you buy or sell more than $100 on Coinbase, you're going to get $10 worth of Bitcoin. So there you go. You get 10 free bucks. basically, what I would encourage you to do is set up an account at Coinbase. It's pretty simple. It links to your checking account, but don't buy anything on Coinbase. Once you've opened this account, you can use their higher end platform, which is this guy here. It's called pro.coinbase. From here, you can buy a lot of the major currencies. Now, of course, it's not as near as expensive as Binance. Binance has way more to choose from than Coinbase, but Coinbase is based out of San Francisco or the Bay Area, so I can go up there and raise hell if something goes wrong. So I'm keeping most of my exchange assets are going to be at Coinbase. Now, that said, there was a question that said, tell me this should be logged in here. Better be logged in. I don't want to have to log in again. It was saying, I don't have enough to pony up for $33,000 worth of Bitcoin. Well, as this loads up here, you don't have to buy $33,000 worth of Bitcoin or whatever each Bitcoin is. It's divisible. So Bitcoin can be traded in as little as 0.0000001 increments. That's called a Satoshi. It's the smallest increment that you can buy. And if you do the math on it, it's like, 1,000th of a penny or something. So for those of you out here, oh boy, you wet your feet on Dogecoin. The funny part is, Dogecoin, the guy that created, even says it's a scam. He goes, it was an absolute joke coin. It was no purpose for it other than to make fun of the crypto space. That's what Dogecoin is. So don't look at that as being a long-term, having a lot of utility. that one's a bad one. Anyway, what I'll do here real quick is you can do several different ways here for those that have never bought it before. This is linked up to my checking account as well. I can go to portfolios. You guys have seen this before. Hopefully it doesn't show my account number. If it does, I'm in trouble. But here is the portfolio that's in this account right now, which has got just a drop of Bitcoin. You can see right here, I have 0.0000296 Bitcoin here, which is 93 cents. I've got a bunch of Litecoin, and I have a bunch in US dollar. So if I wanted to trade this, and let's say I wanted to buy 0.001 Bitcoin, well, here is the Bitcoin order book. I can see all the transactions coming through. I could say maximum amount, or let's say I want to buy 10 bucks worth. How about that? I want to buy $10 worth of Bitcoin. It's going to cost me 44 cents to do that, but I will just place it out of market order. So I'm going to buy $10 worth of Bitcoin, and I just bought $10 worth of Bitcoin. So I bought $10 worth, but how can you buy $10 worth? Well, it's because I bought, right here you can see 0.0031695 Bitcoin. That's what I just transacted, right? Yeah, Richard, is that the same as the Merlin coin? Well, what's really bizarre about that, Richard, is if you look at the market capitalization for Dogecoin, it's like $4 billion. $4 billion for something that was meant to be a joke. The guy who created that thing has got to be laughing his ass off right now, having made so much money on something that was an absolute joke. You guys are funny. Yes. So anyway, I just wanted to show you that was a live transaction. It was that quick. You saw it filled instantly the moment I hit that button. But for those that are afraid of getting into Bitcoin or cryptos, I think right now the only thing that you need to fear is the volatility. I don't think you need to fear the security of it if you're using a good exchange, something like a Coinbase or Binance, or would be the two that I would drive people to if I had to choose an exchange. You can buy as little as you want. There are certain limits, right? Sell those quick. Chris says, what was the commission on this $10 Bitcoin? You can see right here it says fee. It was 3 cents. So I paid 3 cents to buy $10 worth of Bitcoin. So I basically only own $9.97 worth of Bitcoin on this one. So I'm hoping you guys can see that. If you can't, I'll try to, maybe I can zoom up my screen bigger. It doesn't really change the font size. Sorry. But I just wanted to show you that to show how quick it was. I mean, it was very quick, easy to do. And if I wanted to sell it, here, I can just go ahead and sell that right now. I'll just say sell $10 worth of Bitcoin. I type in 10 bucks over here, click on that sell side. Oh, interesting. So when I buy, it says how much in US dollars do I want to buy. When I sell, it says how much Bitcoin. So I now have to go in and type in all of those decimal points. So anyway, if there's questions on that, just let me know. I really just wanted to quickly show people, because it's a big misconception that, oh, Bitcoin's at $31,000. I can't afford a Bitcoin. You just have to do a very small amount. And then Chris says, well, how do you move them to a private wallet? Ooh, that's a good question. So let's see. So let me go here, and you see it says withdraw. So there's withdraw. I can go to withdraw, and now it will ask me what I want to withdraw, right? So here's some Bitcoin that I've got sitting there. If I wanted to, I can click on this, and I can send it to Coinbase account or a different address. So let's say you wanted to send it to a paper wallet. You wanted to send it to hard storage like Nano Ledger S or a Trezor, or some of these offline devices or another exchange. I would simply click here. Let me real quick move this away from you guys, just in case it's showing me something I don't want you to see, meaning a private key. Okay, cool. You're safe, or I'm safe. So here's what would pop up. It says withdraw Bitcoin. So this portfolio, which used to have about 2.5 Bitcoin, I recently moved those to BlockFi to collect some interest. I would basically just enter that Bitcoin address here where I wanted to send it to. And I could type in here how much. And then let's say I wanted to send, let's do 1 Bitcoin, right? I have insufficient funds. It's going to only let me do what I have. So 0.0003 I think is what I had. So it would charge me nothing here for that Bitcoin, for that fee. Anyway, that's how you would do it. You would type it in here, you type in the address, and you would send it. It's that simple. Just make sure that you don't try to manually type in the numbers like this. Oh my God, don't ever manually type in an address in Bitcoin. You're copying and pasting the address, and make sure it has the front numbers and back end numbers the same. What I mean by that is this. So let's say if I want to deposit Bitcoin. Okay. So here is the Bitcoin address for this account, right? So you guys can see there's the wallet address. If you want to scan this, it'll tell you how much Bitcoin's there. You copy and paste this. Don't ever try to type this in manually, ever. It's the worst mistake you could possibly make because you will get it wrong. Anyway, most of them you're just going to scan this QR code that shows up. So this little QR code in the middle, that's what I would scan. But I always check that the first 2 digits is 3, capital A down here, and the last 2 are capital W, capital P. I always check to make sure that those are in there as well. I'm not worried about everything in the middle. Just to make sure I didn't cut and paste the wrong thing at the end of that. Maybe I copied a portion of it like that and didn't copy the rest. I always check to make sure I copy the whole thing and double check it before you hit that send button. All right, let's go. Brendan, he says, I'm hoping that my latest transfer worked out, or I'm out $4,000. I'm sure you feel this way as well, Brendan. When you hit that button, there's this, even though you did it right, you copied everything, it's perfectly done, there's this moment of panic that rushes through you when you're sending a big amount. I mean, I think I told you, I did a $70,000 transaction in Litecoin a couple years ago, and I was sweating. And it took a little while to show up, but what I did is, if you're sending a big amount, so let's say you wanted to send $100,000 of Bitcoin somewhere, or any cryptocurrency, what I would do is I would send a small amount, like $1 worth, and just see how long it takes, make sure it gets to where you want it to go, and then once it gets there and you're sure it's all good, then send the rest of it. But I just always do that as a test on any big transactions I make. All right, what else I got? Can you leave it there at Coinbase? What is Litecoin? Litecoin is just a different cryptocurrency. It's basically the same structure as Bitcoin, but there's 4 times as many Litecoin, and it's 4 times as fast from a transaction perspective. But we can go. It's all it was someone copied Bitcoin's code and multiplied the number of coins by 4 and sped up the block time by 4. So that's pretty much it. That's the big difference there. Practice on 0.00. Yeah, absolutely. All right, cool. Well, hopefully that answered some of your questions. I'm sure some of you have a lot more than that, so I will do my best to answer those as they come up over the next coming days. I want to go to one listener question here because I guess I'm going to have an hour show today. Danny says, is AMD forming a shooting star today, January 4th, 2021? So why don't I just show you that one there, bring up this guy, and we'll go AMD. The answer is yes, but the difference is this. So if you look at this last candle here, that's this long topping tail. It's not the best. Like, ideally, this little green box that you guys see here, which means it opened higher than it closed, I would love it if it was down here near the bottom. What disqualifies this for me, from my strategy and my way of analyzing candlesticks, is it's not at the end of an uptrend. This is a shooting star if I was to take that candle by itself, and that's it. But it's not at an uptrend. It's at the bottom of a downtrend, right? It's been sliding for the past couple of weeks here on AMD, and then it formed this one. So it doesn't have as much credibility from my perspective as it would if it was up near the top. Let's say, it was up here. Then I'd like it much better, Danny's. But anyway, wanted to get to that one, make sure I got your listener questions since you had the date there, and I wanted to make it timely for you. What else did I have? All right, I got a couple I need to get to, but I don't know if I have guests on the remainder of the week, so I have plenty of time to get to other listener questions. There was this for tomorrow. Let me just bring this guy up. Earnings-wise, there's really nothing to speak of that's important or interesting with regards to earnings, so I'm not too concerned there. For tomorrow, you do have a bit of U.S. announcements. You guys can see here we have the ISM manufacturing PMI and prices. You have total vehicle sales, and then FOMC member Evans will be speaking tomorrow. And these are all during market hours, so that might add a little bit of volatility. One of the more noteworthy ones, especially if you're trading oil futures from the pre-market at all, is you have OPEC. OPEC meetings have been creating more volatility in the crude oil space, understandably, because they'll talk about production and cutbacks and things like that. So I would be, if you are trading the crude oil futures at 1 o'clock in the morning, be careful because that OPEC meeting could create some waves. Other than that, you don't have too much. A few announcements about the euro, but that's going to happen tomorrow after this show. That'll be German preliminary CPI as well as French CPI numbers. All right, I think that is going to do it for me because I don't have any other earnings announcements, so we'll keep it there. If you guys have questions, comments, feedback, things you'd like me to discuss, I know a lot of you did send in a bunch of material or questions you want me to get to. I'll probably dive into more of those this week. I'm going to try to get a few guests on. You guys have requested a few different instructors from OTA and other companies out there that I'm going to see if I can get to come on this week. So if you have any questions, you can see the emails on your screen. It's TraderMerlin@gmail.com. You can send me questions there anytime you like. Obviously, the easiest way would be to go down below the YouTube video. That helps the reviews as well. So put your comments down below the YouTube video. Hit that thumbs up. Share the show. Again, thank you guys so much for joining us for our maiden voyage for 2021. Hopefully, we'll have a pretty eventful and busy year. So thank you guys so much. I will see you tomorrow. Take care.